This is the Daily Market Rundown live from the Tradelo trading floor. It's April the 25th. Some highlights from today's show. China is playing the long game on tariffs. The Nasdaq is now staging a dead cat bounce. And VIX volatility is yet to stay. Good day traders, happy Friday, and let's get started and stuck into today's rundown topics. Looking across, of course, Europe, it's quite a subdued session. We can see, of course, a nice positive start in Europe, and that's followed through, of course, after the positive Asia session, and likely to follow through into the US session. Why? Well, there's a number of things going on. Of course, we did have very, very good Google earnings. We'll talk about that in a moment. But just generally, I think the consensus now on Wall Street is we are past peak tariff retaliation, and effectively the thinking is things can only get slightly better from this point as opposed to worse. Okay, now that ultimately doesn't mean that we are now going to rally back to record territory in terms of risk assets, but it does mean that sentiment around taking risk in the market has improved somewhat. Okay, we'll talk a lot about that today. That's going to be the theme of today, which is, how much room does this move have further to the upside in the risk markets, and what can you expect, and ultimately what did we learn from 2022's dead cat bounce in the Nasdaq and S&P. That being said, of course, let's get over and talk about our first topic for today. It's all about China. And there's a double-edged sword here. I think the article has, or the media that has sort of looked at this one way. I'm looking at it a different way, and I want to explain it. So China's come out and they've effectively granted some exemptions on certain products. Okay, think sort of medical equipment from the US. They've granted some sort of a tariff relief on that, as well as obviously some chemicals that are important, strategically important for China. Now, very, very important. The market, or at least the person that's written this, has seen this as a more further de-escalation. I actually see it very differently. I think this is, rather than a de-escalation, I think this is actually China digging in. Okay, in the same way that the US came out very early on to say, look, we will exempt smartphones, like Apple will exempt certain computer hardware and from tariffs. The reason they did that was because had they kept those tariffs in place effectively, these are very high demand products in the US. Okay, so they don't want to impose and affect and hit consumers with massive increases in tariff rates on products that are very widely in demand. Okay, and it's the same in China. China recognizes that these are very, very important products. They don't want to see a freeze up in terms of the demand for these products because of high prices, and so they are now looking at ultimately exempting them. What this does mean effectively is that China's digging in for the long run, okay? Because strategic products, if they can exempt those, ultimately they can still get them in, and then they can go on and battle with the US for the other tariffs looking into the long run, okay? So I think rather than this being a positive, I think it's more sort of signs that China's not going to let up anytime soon. They are effectively saying to the US, the only terms under which we are willing to sit down and negotiate is for you to remove unilaterally all those tariffs you put on us, and then we'll come to the negotiation table. Okay, I think that's the way China's looking at this. They are not going to ultimately come to the table until the US does that. And again, so what this means is we're not likely to get any kind of resolution out of the US and China until, of course, Trump comes out and says, look, we'll remove all those tariffs back to effectively Liberation Day where we were, and then we can have a come out for, which is that complete unilateral removal of tariffs from the US. Will we get it? Well, again, it all depends on ultimately what the market's doing. We spoke about that earlier this week. So long as bond yields remain relatively stable, I do suspect the US is also going to dig their heels in and just wait ultimately and see if that forces China's hand. Okay, so it's very much a stalemate. I think that's the way to look at it. And what that does mean is that investors are going to remain very, very uncertain at this point. They're not going to want to commit until we do get some degree of certainty as to what exactly is happening with China. Now, with that in mind, let's turn our attention and talk about our second sort of news topic for today. That was a bit about South Korea. I think this is important because now we've seen, of course, quite a bit of rhetoric around Japan, of course, first, then it was India, and now we're seeing it around South Korea. And I think the key takeaways from this article are extremely, extremely important because they almost mirror what we read about Japan yesterday. Okay, and we spoke about this in the market rundown yesterday, where we said Japan seems to have picked up on a negotiating tactic, which is to move slowly and force the US's hand into concessions because they know the US ultimately needs to get deals done as quick as possible. Okay, now South Korea is a very interesting one again because there was news out yesterday and the US was saying and terming it as we had a very successful meeting. That's what Scott Besson's saying. He's saying, look, ultimately things are moving along very, very quickly, a lot faster than expected, and next week we should get to technical terms. So from the US's side, they're talking it up as though deals are happening fast, lightning fast, and all these countries are effectively giving certain concessions, and as a result, they can drop off the very aggressive tariffs or the reciprocal tariffs that are being imposed on them. When we look at it in terms of the wording coming from the South Korean side, it's almost the opposite, okay? Where it seems that South Korea is in a cautious mode. Ultimately, we had the former trade minister saying there's a real discrepancy between how the US is terming things and how ultimately the South Koreans are terming things. And ultimately that South Korea was talking about this idea of a July package, and they weren't in any rush to deal. Okay, so they're seeing this as we've got 80, 90 days. We're not going to rush into agreeing to just everything. We can really kind of bang out the terms of this, really kind of take our time in getting a sensible deal. Okay, I think that's the key takeaway, is that the US is wanting these rush-through deals, whereas now not just South Korea, but also Japan, they are talking about, look, let's move slowly. Let's make sure that we actually do get a fair deal rather than just accepting the terms of the US. Okay. Now, why does this matter? Why does any of this matter? Well, like I said yesterday, the key theme for the rest of this year is going to be uncertainty. Okay. Now, if uncertainty is the key narrative for 2025, you're not going to get a sustained bull market rally in the equity market. Okay. Moreover, and this is important to stress, you are not going to get the Federal Reserve cutting interest rates until they get some degree of what is going on with regards to tariffs. Okay. So the point is that we're not going to get a central bank policy response, and we're not going to get a fiscal response. Remember, Trump's been talking about this idea of tax cuts, deregulation, but he's not going to start on that until he solved the tariff situation. Okay, so we're not getting any fiscal responses here. We're not getting any central bank responses here. All we're getting is a lot of uncertainty because there's a big, long conversation taking place all around tariffs. Okay, the longer these tariffs play out, the more uncertainty there is. And if there's uncertainty, that means high volatility for an extended period of time. And of course, it means investors will not be committing to the stock market until further notice. Now, why does that matter? Well, what we'll talk about in a minute is the dead cat bounce in Nasdaq. We will compare it to 2022. But there you can see the VIX, and I think this is a good place to start before we segue on to looking at 2022 in the dead cat pounds. Now, in an uncertain environment, what that means is a higher vol. Okay, think of it as a vol regime change. So what I mean by that is if you compare it to 2024 and you look at the 200-day average of VIX over, for example, last year, you can see it was probably, let's call it 15. Okay, if I was to take the average of the entire 2024 of VIX, it was probably around 14 to 15. Okay. Now, a vol regime change is just effectively where we move to a different type of vol environment. In other words, the average for this year, 2025, come the end of the year, is probably going to be closer to 20. Okay, call it 18, 19, 20. Okay, it's a shift from 15 to 20. And in a high vol environment, in a high average volatility environment, you do not get sustained rallies in equities. Okay, you get a lot of volatility by definition. Now, that doesn't mean vol can't come lower. Okay, I think what we will see and what I expect to see is I continue to expect to see this volatility come back down towards that 20 mark and then of course bounce and move into this just a general range of higher volatility. Okay, now cast your minds back. Theory, when the VIX is above 20, that's typically a risk-off environment. It's not an environment in which investors are taking cash off the sidelines, putting it into the stock market. Okay, and I think that's key because if we are in a higher vol environment, if we have shift in terms of regimes, you're not going to get any sustained rallies in equities. Okay, and you have to have that hat on of selling into equity bounces. Now, You can take a look at this. This is effectively the Google headlines. And ultimately, let me just segue. I'm going to quickly come to Google and then I'll move back onto 2022. So Google came out yesterday, announced its earnings. Again, no surprises there, beats on everything, really, really good. The key sort of focus was all about capex. And again, they've come out and said we're not going to revise down 2025 capex. Now, some of the pundits in the market are saying this is good. This means that AI ultimately is safe and the bubble hasn't burst. I actually take the other side of that idea, which is I think focusing on 2025 capex is a mistake. Why? Well, because you don't just roll out capex and then cancel it all of a sudden because of a bit of uncertainty around tariffs. Okay, the reality is that this capex commitment was already made probably in the start of 2024. Don't forget, when you're doing big projects and doing the ROI on these big projects, it takes almost a year to ultimately go and ultimately see what sort of returns you're going to get on big projects. Okay, moreover, once they begin the process of investing in these projects, they don't happen overnight. Okay, so a lot of the 2025 capex was already agreed to. It was already passed by the board already in 2024, and so they are committing to what they already said they're going to do last year. Okay, it just happens that the spend is happening this year. Okay, so the important thing to pay attention to is not necessarily the capex for 2025, but the capex coming in 2026 and beyond. Okay, now we might find out from the likes of Microsoft and of course Meta and Amazon, who will report later on. We might find out from them ultimately what their capex ideas are for 2026. But again, I suspect they're all going to be very, very hush-hush. Okay, the reality is right now, no one wants to be committing beyond the next 3 months because it is a very uncertain environment. Okay, so don't focus too much on this. I think this idea that they committed to 2025 capex and that's a good thing, I think that's rubbish. I think the key thing ultimately is what is going to happen with 2026. I suspect they are going to scale back on that capex spend simply because right now the focus is not on AI. Yes, AI is still a very, very impressive technology, but the reality is the market's so fixated on what's going on with regards to tariffs that I'm not sure we are going to see AI return to record levels anytime soon. Okay, with that in mind, there is the Google chart. We are set to open around that 170 mark. Don't be surprised to see us get up to 172 today, at which point don't be surprised to see investors step in and sell it there. Why? That is the 200-day moving average. You can see it has offered quite a bit of resistance over the course of the March and April month. Okay, keep an eye on that. I think a good one to pay attention to. Fantastic company. It's not to say that Google won't be shining bright in the years ahead, but right now, like I said, it's an uncertain environment. Investors are not wanting to take any kind of cash off the sidelines with all the uncertainty. Okay, with that in mind, let's turn our attention to talk Nasdaq. Let's talk about a dead cat bounce. Let's talk about the pattern itself. Okay. Ultimately, the best way to look at this is a sort of, I'm going to frame it for you in terms of a market response and in terms of price, and then a policy response. Okay. Now, it's, you often see sort of people talking about historical sort of patterns and repeating and all that, and I think 2020 is a very, very good pattern or a past history pattern to look at. Why? 2022 effectively was the point at which we started to see central banks get quite aggressive in terms of hiking rates. Okay, so we had equity market valuations at extreme levels. We then had central banks hiking quite aggressively, and ultimately that created what was a 35% or call it 36% drop in the Nasdaq over the course of 249 days. Okay, so a good year of a bear market rally. Now that's the first reference point to mention because for an entire year the stock market went down. Okay, now people have very, very short-term memories in that they think, oh, every correction gets bought, and I can understand why, but the reality is when we do get a bear market, ultimately they don't last for just 2 months. Okay, we're 2 months into this year, this bear market is 2 months in. Don't think that it's ended just because we're seeing a rally in the markets. Okay, and I'll tell you what ultimately is sort of one of the key things to focus on that defines whether or not the bear market's going to continue or not. Okay, the first one I mentioned was uncertainty. Okay, for a market to come out of this bear market and suddenly start to rally, we're going to need certainty. Now, with a VIX above 20, with all the ongoing negotiations around tariffs, there's too much uncertainty for anyone to conclude that this bear market's over. Okay, the reality is no one's going to invest in these markets until we get some degree of certainty. Now, the second key takeaway is policy response. And the best way to think of this is in 2021, ultimately, keep in mind central banks were hiking. So we had no support from a policy perspective from the central banks because they were ultimately hiking. They were putting restrictive policy in place to take money out of the system. Okay, so the central bank couldn't respond. In terms of the fiscal response, we still had quite a bit of fiscal response. Keep in mind, of course, there was quite a lot of spend going on from the US government, and in fact it was the US government under Biden that came out that ultimately created the October lows. Okay, that was when we got that significant fiscal response from the Biden administration. That ultimately was the low tick in October 2022. Okay, now the key takeaway is that we're not going to get, or we didn't get, a central bank response. We got a fiscal response late in the bear market rally, and it's only when we got that fiscal response that we then saw the end of the bear market. Okay, now why does that matter? Because let's now move on to and look at the current day, which is, have we gotten ultimately uncertainty out of the way? The short answer is absolutely not. And we're going to be in an uncertain environment for the foreseeable future. Okay, like I said, we're not going to have a certain environment for at least the next 90 days. And like I said yesterday and today, it's not likely that we are going to get everyone a trade deal in the next 90 days. Okay, we can already see with South Korea and Japan, they are both willing to run down the clock to get concessions out of the US. Okay, so we're still going to have an uncertain environment 3 to 6 to 9 months from now. So that pillar of support is not going to be there for the market. Let's think about central bank support and fiscal support. Is the central bank, is the Fed going to suddenly start cutting rates anytime soon? Absolutely not. We've heard from Jerome Powell right now, they are fixated on getting certainty before they make the next move. Is that certainty coming in the next 3 months? Absolutely not. So we're not going to get a response from the central bank anytime soon. Are we going to get a fiscal response? Again, if Trump was to come out and suddenly start talking about tax cuts and deregulation and actually putting policy in place, fine. We could argue we are getting a bit of fiscal response. However, like I said, the US administration is not going to start talking about tax cuts until they've solved the problem with the tariffs. Okay. Moreover, they can't start talking about tax cuts when you got 10-year bond yields sitting at 4.35. Okay. Once that gets resolved, once bond yields calm down, fine. Then we can talk about tax cuts, because you're not going to get the bond vigilante smashing your bond market. Okay. The key point I want to stress is that we are not going to get any fiscal or central bank response to save this market anytime soon. Okay. And that's why we are now very much in a bear market. And like I said, they don't last 2 months. Okay. These sorts of things last at least a year. And if we don't get a policy response at some point this year, then it can last a number of years. Okay, and that's the first thing I want to stress. Now, with that in mind, ultimately, how deep can this bounce? Well, let's look at 2022, because we got that initial sell-off. We then had the first bounce. Okay, we got the sell-off. We got the first bounce. We then got an extension. We then got an extension, and then the market bounced. And where did it bounce back to? All the way to that starting point. Okay, so if I was to relate that, we got all the way back to that 2300 mark, effectively in modern day. The market then extended. Okay, the market's then going to extend. We then had a shallow bounce and a deeper bounce and little extensions. Okay, the point is the first move is always the deepest, and then thereafter the market kind of enters what we call the zigzag pattern, where it makes lower highs, lower lows, lower highs, lower lows. Okay, so we can see a lot of this pattern is very familiar. It was the exact same pattern we saw in 2022. Moreover, if I just point this out, I just want to quickly erase this so you can see it. If we look at ultimately what happened, particularly in this little time frame, you can see what we call one time framing. In other words, a very bullish type trend where the market almost just seems to go up every single day. Okay, this is the kind of price action you're looking for. You're looking for the sort of price action where the VIX drops every day, perhaps back down towards 18, 19, and you see the S&P staging this one time framing where it feels like it just goes up every day and everyone is getting long the top of the market. Okay, it's at that point that ultimately you want to look to be entering short the market. Okay, like I said, somewhere around that 2300, I think that is going to be a very important level. In retrospect, I think we'll look at this in a couple of weeks' time and go, oh, it was so obvious. You just had to sell 2300 and you made 3,000 points in a relative quick space of time. Now, the key thing to stress about a dead cat pound, so if you go view enough of them, what you will notice when we do eventually roll over is it comes quite quickly. Okay, why? Well, the way you want to think about this is in terms of supply and demand. If everyone is effectively just looking to be short at this 2320, it means no one's really shorting it here yet. Okay, yes, you'll start to see big players who need liquidity start to perhaps enter around that 20,000, 20,300, etc., etc. But the reality is once the market finds that turning point, no one wants to be long. Remember what I said to you, in an uncertain environment, no one wants to be long the market. Okay, the people that do want to buy, fine, they'll buy it back down here at 16,000, but they're not going to buy it, at 19,500 after we pull back 2%. Okay, that is the reality situation, is liquidity will disappear once we start to turn, and that's why you get a very quick move back down towards the low of the range. Okay, if we compare that to 2022, look how quick the move was. Sell, a little bit of consolidation, sell, a little bit of consolidation, sell. Okay, within a space of almost, call it 2 months, we would already be making a new low effectively in the bear market. Okay, so just keep an eye on that. That is a typical traditional bear market rally and rollover, and it is something where I'd expect will probably extend around that, below that 16,500, perhaps down to 16,000, and then again we repeat, we do this exact pattern. Okay, now levels, and this is again we're going to lean on 2022. Yeah, what you're looking at is in yellow is effectively the Nasdaq price, and then we've got a series of moving averages. Now the reason I do it this way is because I like to see ultimately how price responds at different moving averages. Anyways, the one I want you to pay attention to is the purple one, because that's the 200 moving average. That's the one that long-term investors lean on to get an idea of trend. Now, in a bear market, what you can see is the trend is very firmly down over the course of a year. Okay, and yes, people lean on these moving averages, but I think the key thing is the shape or the direction of that moving average. Okay, now in a bear market rally, what we can see in 2022 was we first came back to test that moving average. We sold off, we came back to test the 200 moving average this year. We then extended. What did we do? We came all the way back to test the 200 moving average. Okay, and that's why I suspect again this 20,000 to 20,300 is going to be a massive resistance area where everyone is thinking the exact same damn thing, which is if I'm not out of my positions, I now want to get out of them. If I'm looking to get out of profit taking because I bought on the dip, that's probably where they're going to get out. Okay, keep in mind, no one is looking for a sustained rally back up toward record highs, not in the current environment. Okay, fine. If we got a degree of certainty tomorrow and Trump said no more tariffs, I changed my mind, and ultimately he then focuses on tax cuts, sure, we can be at record highs and the entire game flips on itself. Okay, but the point is, with uncertainty and no fiscal or central bank response, we are in a sustained bear market rally, and the key is going to be that 200 moving average. Okay, and then like I said, you can see we extended, we came back, we failed to get to the 200 moving average, we extended, we came back. Notice we then passed through the 200 moving average, came back one more time, and that was then the start of a prolonged bull market. Okay, that's then a wrap for today. Hopefully you've learned a little bit about bear market rallies, a little bit about technical analysis, a little bit about how to think about the next 3 to 6 to 9 months. This is very much a fluid environment, but you really need to see it with the hat on of it's an uncertain environment. Okay, investors do not take long-term positions in uncertain environments. Okay, and that's going to be the theme for the rest of this year. And if you can have that sort of mindset where you need to be trading uncertainty, and that's the narrative where you can capitalize on, then you will do very, very well in these sorts of conditions. Okay. With that in mind, it's been a bit of a long session today. Thank you for joining me. For those of the Tradelo members that have got any questions, do post them in the Discord channel. Otherwise, happy Friday. Good luck out there. Manage the risk. Go make some money.